Hey everyone, I'm Jeremy Szafron. You're watching Kitco News. Don't forget to hit that subscribe button for the latest. Now, we're looking at a critical moment in the economy as U.S. job openings have hit their lowest point since 2021, with layoffs increasing, indicating, of course, that a labor market is cooling faster than many had expected. Now, this data has caused the U.S. yield curve to disinvert briefly, and of course, that's a signal that many believe point to an impending recession. And at the same time, Federal Reserve official Raphael Bostic has pointed out that risks to inflation and employment are now more balanced than they've been in years, but they aren't actually ready to yet declare victory over inflation. And adding to the tension, tech giant Nvidia is under scrutiny, facing an antitrust probe as the Justice Department investigates its dominance in the AI market. Of course, that raising question here as to what that means for the broader markets. Of course, today they're reacting. Not looking too bad. The S&P 500 is showing some strain, and investors watching closely for the Fed's next move. Now, to help us break down all of this and explore what it means for the markets and, of course, the broader economy, we have a good friend of ours on, Peter Berezin from BCA Research. Hey, Peter, welcome back to the show.
Good to be back on.
As I alluded to, we got lots to get to off the top. It's a busy news day. We saw that the U.S. job openings fell to their lowest level since 2021. Layoffs are ticking up. Fed officials like Bostic, as I said, are saying that risk to inflation and employment are balanced now. But what's your take? Are we heading towards a softer labor market? And what does this mean for the broader economy?
Yeah. A couple of years ago, when I was actually quite bullish on the U.S. economy, we had millions of job openings. Anyone who lost their job could walk across the street and find new work. And that was really formidable insulation for the economy. That's what kept the U.S. out of recession. But fast forward 2 years, things aren't looking so good. The vacancy rate is down to 4.5%. That's the level that Fed Governor Christopher Waller has identified as the potential tipping point at which unemployment could start really rising rapidly if openings keep falling. So unfortunately, I think we are getting close to a recession. Most likely, it'll start towards the end of this year or early next year.
Interesting. Okay. So with the JOLTS report showing job openings significantly lower, as you said, does this suggest then that the Fed's balancing act between, is it leaning more towards a potential hard landing at this point, I guess is the question?
Well, I think that's going to be the inevitable outcome, and the Fed will try to avoid that outcome. Of course, we want a soft landing. But the problem for the Fed now is that the market expects a lot of easing, and long-term bond yields, mortgage rates have already discounted all that easing. So for the Fed to bring down bond yields any more from where they currently are would require them to cut even more than what the market is expecting. I don't see that happening outside of recession. And so I think the Fed is behind the curve, and we're slowly sliding into a recession.
Yeah, well, let's unpack that a little bit, because as I said, Bostic also mentioned that inflation risks remain despite the progress being made. So do you think the Fed is positioned correctly here, or could they be moving too slowly, given that some inflation drivers like energy are creeping back up?
I don't envy the Fed's job. There's a famous metaphor by Milton Friedman, the fool in the shower, where you're trying to adjust the temperature in the shower. There's a long lag between when you turn the knob and when the temperature adjusts. And so you're either too hot or too cold. That's the challenge that the Fed faces. When you're at full employment, you got to get monetary policy just right. If rates are a little bit too low, you could get inflation coming back. If rates are too high, unemployment will begin to go up, and that'll feed on itself. So yes, the Fed could just turn the knob and get the right temperature. But if you're an investor, do you really want to bet on such an outcome? With the S&P trading where it is, 21 times forward earnings, I don't think that's a good bet.
Yeah, it seems to be cooling off a little bit today, too. I was watching your, what do we call them now? Tweets? Do we call them X posts? I don't know, Peter. But I was watching you online this morning, and you were kind of, we'll put up this chart in the interview as well. You were talking about these new jobs and the job listing with Indeed as well. Break this down. What were you trying to communicate here?
Right. So the official series on job openings comes from the JOLTS series, the job openings and labor turnover survey, but it's a bit of a lagging survey. I mean, this morning we only got data for July. Ideally, what we want to know is what's happening to job openings in August and into early September. So to get a sense of what the most recent data says, you want to look at some alternative sources, one of which is from Indeed, which of course is a big online recruitment site. Now, if you look at those numbers, what you see is that the overall level of job openings, it's actually been kind of flat for the last few months, which is a bit reassuring. But if you look at new openings, as opposed to the overall level, they have actually been trending lower. And it's those new openings which arguably tell you more about what's happening to labor demand at the margin. And so the concern that I have is that we're going to reach a point in the next couple of months where people who lose their jobs are not going to be able to easily find new work. They're going to be out of work. They're not going to have as much income anymore. They'll be spending less, which means that other companies are going to be hiring fewer workers, and that increase in unemployment will just feed on itself.
Yeah, I mean, it's pretty interesting to watch. I mean, just a couple of weeks ago, we had the Fed go and change their numbers and decrease the jobs report by 818,000. I mean, is the Fed's cautious approach risking a scenario where they'll have to retighten sooner than expected if inflation keeps going up here?
Well, I think that's the concern that the Fed has, that if they tighten too quickly, too aggressively, inflation could come back. Now, personally, I think that's the smaller risk at the moment. I think the bigger risk is that the Fed will cut rates too slowly and it'll be too late, which, by the way, is what has happened in the past. People are very excited about the prospect of Fed rate cuts. But remember what happened in 2000. The Fed began cutting rates in December 2000. The recession started a few months later. In 2007, the Fed began cutting rates in August of 2007. Again, the recession started just a few months later. So I think this is going to be the same story. The Fed will be behind the curve.
Yeah, it's interesting. And I mean, if you've certainly been a Kitco News viewer, we have been on top of this story with our guests. They've been pretty spot on about this. Okay, I want to shift a little bit here because we were talking about the broader market, what these Fed rate cuts might mean. I mean, Nvidia has been hit hard by the news of a DOJ antitrust probe, and it's just a major ripple effect in the tech sector. You know, given their dominance in AI and chip making, how do you see this impacting the future of AI-driven growth and innovation? More specifically, you know, is that bubble, that earnings that you just mentioned, I mean, were we at the top?
Well, I mean, Nvidia trades actually at a reasonable multiple to forward earnings, if you believe those earnings. I think that's the issue. Nvidia has super high profit margins, around 70% or so, which of course is attracting the interest of regulators, and perhaps more importantly, is going to attract competition from other companies. And even if that competition doesn't come, I think you still have kind of this question mark over how much underlying demand there will be for NVIDIA's chips over the long haul. Because what we're seeing now with large language models is that the output of these models is kind of converging, so that if you ask ChatGPT, Claude, Gemini a question, you kind of get the same answer back, which is not surprising because they use similar neural net transformer architectures. They use the same training sets. And so I think the risk to NVIDIA is that its customers just can't make a lot of money from these large language models because they're all kind of indistinguishable from one another. It's like airlines. Airlines are very useful, facilitate globalization, but the airlines never make any money because they're all kind of the same. I think that's the risk for NVIDIA, that the profits from these new technologies just don't materialize in time. And so there's less demand for chips going forward.
Interesting. Okay, so while we see the market's a little bit resilient, I would say, considering, you know, that the S&P has been on such a run this year, what's your trade here, Peter? I mean, what are you looking at? Are you looking at defensive? Are you trying to play the opposite? I mean, T-bills aren't necessarily a thing anymore. Where are you putting your money?
So the trade that we recommended a couple of weeks ago, very simple trade, go short the S&P 500 versus the 10-year Treasury note. We expect the S&P 500 to drop to 3,800 next year. I'm by far the most bearish strategist that Bloomberg covers in their survey. And we expect the 10-year yield to fall to 3%. And if both those things happen, you're going to make 40% by being long bonds versus stocks.
Okay. Interesting take. So then what does the volatility look like in the next coming months? I mean, obviously, we got the election. We got this uncertainty around the Fed's rate cuts. What are you thinking? What are you going to see here? What's your outlook?
Volatility is going to go up. And if you want insurance, buy some puts on the S&P. They're a little bit more expensive than they were a day ago, but they're still reasonably cheap. I think with the uncertainty over the economy, with uncertainty over the election in November, with uncertainty over all sorts of geopolitical matters from China, Taiwan, to the Middle East, to Russia, Ukraine, being long volatility makes sense in this environment.
Yeah, well said. And of course, we have more economic data coming out towards the end of the week. Next week, even busier. And then, of course, Fed's rate cut decision. It never is a dull moment around here. Peter Berezin from BCA Research joining us today to break down his latest thoughts on the economic data. Hey, thanks for this, Peter. Really appreciate you coming out and breaking this down for us.
My pleasure.
Thank you. I'm Jeremy Szafron for all of us here at Kitco News. Thank you for tuning in. Got lots of great content coming all week long. So hit that notification button and stay tuned.